Good evening, my students. My name is Professor Samik Bagchi, working as assistant professor in HI. Today, I will give a short lecture session on the financial risk management. So, first of all, you have to know the financial risk is a very important part in the corporate finance because without financial risk, the corporate finance would not be able to properly manage or function effectively. First you have to know the what is financial risk. The basic definition: financial risk management is a crucial aspect of corporate finance. Involves identifying the risks, analyzing the risks, mitigating financial risks that may affect the company profitability, liquidity, overall stability. In corporate finance, managing risk is very vital to ensure the business can achieve its strategic objectives while maintaining the financial health. So without the financial health, we will not be able to know how the risk is, how to manage risks, how to identify the risks, and how to mitigate this because it is very essential while achieving strategic objectives and properly maintaining the financial health of the company. The process incorporates various tools and techniques to minimize the potential negative effects of risks and uncertainty on the organization. So various tools we have to and techniques we have to know how to minimize the potential negative effects. Potential means the very adverse effect on the risks and uncertainty on the organization. So we have different types of financial risks in corporate finance. First risk is the market risk. The definition: the risks of losses due to fluctuation in market. So it is a kind of loss which will affect the market variables such as the stock prices, interest rates, foreign exchange rates, and the commodity price. When the stock prices slow down, interest rates slow down, or the foreign exchange rates is unstable, and the commodity price also slows down gradually. So examples of the market risk is the interest rate risk. Interest rate with exposure to changes in the interest rates, it affects the cost of borrowing or the value of the investment. So when you're experiencing the change in the interest rates very gradually or adversely, so we affect the cost of borrowing. The cost of borrowing gradually get decreases or increases on the types of the investments on the market. So next is the currency. Currency risk is the foreign exchange. For foreign exchange, we have incorporating different types of in currency. So using the various currency for various kinds of transaction. So it is a risk arising of risks of losing money due to adverse fluctuation in the exchange rate. So when you are losing money, if you're not properly investing in various currencies or various transactions, you'll get a properly fluctuating the in exchange rates in the stock exchange. Next is the commodity price risks. Risks arising from the volatility of raw materials, commodity, or example, oil, metals, agriculture products. So commodities, various kinds of commodity we have in the commodity market. So we have a risk of the losing the prices of various raw materials or commodities like oil, metals, and agriculture commodities. Now, what is the management strategy they are using? Hedging. Hedging is a kind of the strategy where they're using the various financial instruments like derivatives. In derivatives, we have subparts like option, future, and the swaps. So, and next strategy is diversifying the instruments. In diversifying the various financial investment in order to mitigate the exposure to particular market condition. We are diversifying various investments in order to mitigate our exposure to very particular market condition. Next is option. Option is a kind of derivative. It's defined as a kind of the financial contract that gives the buyer or the holder the right but not the obligations to buy a seller asset such as stocks, commodity, bond, or the currency at a specified price that is known as in financial terms strike price before or on a future expiry date or the specified date. Notice the key features of the option. First is the call option. Call option gives the holder the right to buy the unlike asset at a specified price, which gives the buyer the holder to buy the asset at the specified price. Next is the put option. Put option is the holder the right to sell the underlying asset at a specified price. Next is the premium. Premium is the extra price you're purchasing the option. So next is the expiry date. Expiry date is the date on which the option expires. Types of option. We have two types of option: European option and the American option. European option can only be utilized at the expiry date. It is matured at the expiry date only. But the American option, it is the reverse of that. It can be exercised at any time on or before the expiry date. Next is the example of Next, the call option on stock. What is the call option? If the company calls any option for a stock with a strike price of 100 and the company stock price rises to 120. So if the company exercises the option to buy the stock at 100, making a profit of rupees 20 per share, when the company holds in its option with the stock or the strike price of 100 and keep the option till the prices rises. So if the prices rises to 20 per share, the company makes a profit of 20 rupees 20 per share. So we use the option. Option can be used in various purposes as a hedging technique. Hedging can be used to minimize or minimize or avoid the adverse price movements. For example, a company expecting to receive payments in foreign currency can use option to protect against the unfavorable currency fluctuation. Next is the speculation. Investors may use option to make profit from the price movement to increasing price movement without weighing the underlying asset. Is keeping the asset for a long period of time by using the power of speculation. They're gaining the price, they're making the profit or making avoid the unfluctuation. Next is income generation. Income generation. Income sellers or writers or an option can earn the premium income from selling the option. That means when the seller's option can earn the extra income from by selling the option right in the market. Next is the future. Future is also derivative. Is a standardized contract in which the buyer agrees to purchase and seller agrees to sell the asset at a predetermined price at a specified time in the future. It means you want to purchase, if you want buyer agrees to purchase and seller want to sell the contract, sell the assets at a agreed price in specified time in the future. Futures contracts are traded on exchanges and stock exchange, and both the parties are obligated to buy or sell the assets at the contract after the contract is expired. So it is traded on stock exchange, and both the parties agreed to buy or sell the asset at a contract expiration. Next is the standardized. What are the key features of future contracts? First is standardization. Future contracts are standardized, meaning that the terms such as contract size and expiry date it's a kind of standard contract where the whole all the contract features, contract buyers terms and condition and the maturity date all are fixed by the exchange. Then margin report, the parties must deposit some amount of money. That is a collateral security to enter into a future contract. This margin helps to ensure the contract is honored and contract is accepted. Next, the settlement. Future contracts can be settled either by physical delivery of the asset or by cash settlement. That means you can have a physical delivery, you can settle the contract by physical delivery of the asset or by using cash. It's based on the difference between the contract price and the market contract price, where you have fixed the contract price at the time of entering the contract and the market price up to the time of maturity of the contracts. That is example of the future contract. Company relies on oil for production may enter a future contracts to buy, sell the asset at a fixed price in 6 months. That is a future contract may enter into by the two parties where you are agreed to buy the oil at a fixed price after 6 months. That is 6 months in future. This guarantee the company the known price and protecting from the rising oil. That is, you have guaranteed yourself with the price that is fixed by the two parties and give yourself the protection from rising the oil prices. Use of future. Future can be used for many purposes. First is the hedging. Company use future contract to lock in the prices for commodities. Example, agricultural products or financial assets at stock indexes interest rate to reduce the risk of the price fluctuations. Company use future contracts to lock the price of the commodities. Example, in various like oil and agricultural products or any kind of financial assets, example stock indexes or interest rates, in order to reduce the adverse risks of the price fluctuation. Next is the speculation. Traders can speculate on price movements in the underlying asset such as commodities or stock index without weighing the asset himself. Trader can speculate the price movements after analyze the assets and the terms and condition of the assets in the market without owning the asset himself. So arbitrage. What is arbitrage? Arbitrage means you can experiment in different markets by exploiting the price differences between different markets of the assets. Next is the swaps. Swaps is a derivative contract in which two parties agree to exchange swaps or cash flow or financial instrument over a specified period, typically based on the underlying asset. That is a kind of the derivative contract only, where two parties agree to exchange their cash flows or the financial instruments over a specified. That is a cash swaps means in exchange of the cash flow or the financial instruments over a specific period, typically based on the underlying assets or the interest rates. Swaps are primarily over the counter. What is the counter contract? It takes place over the counter, meaning they are customized already and traded privately between the two parties. It is already customized between the two parties and it is meaning executed privately between the parties. Types of swaps. First is the interest rate swaps. Involve the exchange of interest rate payment between the two parties. One party paying the fixed interest, other party is paying the floating interest rate. Is the interest rates swaps. Example: in company the floating rates might enter into a fixed exchange rate, swap to enter into a floating interest rates, or for a fixed interest payments to protect itself from the rising interest rates. Next is the currency swaps. Involve the exchange of cash flows in different types of currencies. Typically, the parties exchanging both the principal and the interest payments in the respective currencies. Example: a US-based company may enter into currency swaps with a European company to exchange US dollar for euros at agreed terms and to order to manage the foreign exchange rates. Next is the commodity swaps. Next is the commodity swaps. Commodity swaps. What is commodity swap? Commodity exchange of cash flow on the basis of the price of a commodity such as oil or the gold. So, example, company that use a lot of oil or production may enter into a commodity swaps and try to exchange the variable oil prices for a fixed price. It's a company that use oil as a commodity in production may enter commodity swaps with another parties in order to exchange into variable oil prices in order to exchange the variable oil prices. So, in online lecture. Hello, sir. হ্যাঁ স্যার অনলাইন লেকচার আছে হ্যাঁ হ্যাঁ এই 10 মিনিটের পর শেষ হয়ে যাবে Next is the currency credit default swaps. If it is a kind of insurance swap that against the default of borrower, example a company or the government bond issue, it is an insurance. It's a kind of insurance swaps based by the borrower. If the default of the borrower, example a company or the government bond issuer. So if the borrower is a company or the bond issuer is a default, it is the buyer of the credit default swaps pays a regular premium to the seller in exchange for protection in the case of the issuer debt. That is, if the buyer who have bought the credit default swaps pay regular premium to the seller in exchange for protection. That is, who will be the guarantor? The guarantor will be the bank or any kind of financial instrument in case the buyer who is a defaulter. So either buyer can default, the banker or the any government pay the regular premium to the seller in exchange for the protection in case the issuer defaults. Example: if a company holds bonds from another company, it may buy CDS to protect itself from the risk of default by the bond issuer. That is, if it holds the bonds from the another company, it may buy CDS, that is credit default swaps, to protect itself from the risk of default. Use of swap hedging. Swaps can be used in various purposes for hedging. Swaps are currently used by the business to hedge against changes in the interest rates, exchange rates, or commodity. So it is helps to protect themselves against the increase or decrease in the interest rates, exchange rates, or the commodity price speculation. Investor and trader can use swaps to be on the exchange, bet on the exchange, changing the interest rates, currency values, or the commodity prices. Next is the arbitrage. Swaps can be used in the arbitrage strategy where entity capitalize on discrepancy in pricing between the market. If there is any discrepancy in pricing between the markets, swaps can be used as an arbitrage strategy. The next is the credit risk. Risk that borrower will default on a loan or other financial obligations causing loss to the lender or the investor. That is if you are taking a loan, you fail to repay the loan on a timely basis, causing a loss to the lender or the investor. Example: default risks. The chances that the company or the counterparty failed to meet its default obligation. Next is the counterparty risks. Risks that the other party in a financial transaction, example supplier, customer, or the financial institution will get default on agreement. That is, if their counterparty get default in the paying of the debts or obligation, they may be called a defaulter in an agreement. What is the management strategy? They are applying credit analysis and the rating of counterparties. We have to rate the counterparties' financial health and the credit rate analysis to also assess the risk level. Use of the next is the use of the credit derivatives such as credit default swaps in order to protect against the default. That is, if you are using any credit derivative instrument in order to protect itself from the credit default swaps, like limiting exposure to higher risk clients or now you will not be giving access to the higher risk clients or the sectors. Next, liquidity risks. Liquidity risks that the company not able to meet its short-term financial obligation due to seeing insufficient cash flow or inability to convert asset into cash without significant losses. Example, funding liquidity. When a company cannot raise capital or borrow funds to cover the obligations. Next is the market liquidity risk. When a company cannot sell the assets quickly at the markets due to lack of buyers or market disruption. Next, management strategies. Maintaining adequate cash reserves and credit lines you have to make in order to avoid the liquidity risks. A regular cash flow forecasting to ensure that liquidity needs are anticipated. Structuring debt in such a manner that balances short-term and long-term repayment obligation. Next is the operational risk. Definition: the risks of loss due to inadequate or failed internal process system or external events. Example: system failures, fraud, human errors, or disruption in the supply chain. Management strategies. Implementing robust internal controls and auditing systems is very necessary. Regular training of employees and updating the operational procedure. Next is the use of insurance to protect against significant losses from the unforeseen events. Strategic risk. What are the strategic risks? Risks that business decision or the process or strategies may fail to meet the company objective lead to financial losses. Example: market entry failure, product recalls frequently, or poorly executed merger and acquisition. Next is the management strategies. Strategic planning and scenario analysis is to assess the potential outcome of the decision. Regular review of business strategy in order to ensure alignment with market condition and company objectives. Next, rigor and regulatory risks. Risks of financial loss due to non-compliance with laws, regulation, or contractual obligations. Example: fines, penalties, or litigation from non-compliance with government regulations. Management strategy: ensuring compliance with the applicable law through legal audit and reviews. Monitoring changes in the regulatory environment and adapting business practices accordingly. Next, what are the financial risk management techniques and tools? First is the hedging. Hedging is the most important common strategy used to offset the risk by taking an opposing position in a related asset financial instrument. Example: derivatives like future, option, and swaps. Example: company that exports goods may use currency forward to hedge against the risk of currency fluctuation. Next is the diversification. Diversification investment across the different assets, industries, and geography can reduce the exposure to specified risks. Example: company may invest in different sectors like technology sector, energy sector, and consumer goods sector to protect against the sector-specific downturns. Next is the risk transfer. Risk transfer involves passing the risk to the third party through contracts, insurance, or other financial instrument. Example: company may transfer the risk for a certain operational risk. Example: property damage, business interruption through the insurance policy. Next, risk avoidance. Risk avoidance entails altering the company strategy to avoid the risks together. That means altering your company strategy in order to avoid the risks. Example: company might decide not to enter into volatile market to avoid the risk associated with the market. Next is the risk retention. Company may choose to retain the risks, accepting them as a part of the business, particularly if the cost of mitigating the risk is too high. Example: company may self-insure against the minor operational risks rather than purchasing expensive insurance. Next, the other risk management process in corporate finance. First is identifying the risks. First step is identifying all the potential risks the company faces as the market credit risks, liquidity risks, and operational risks. Next is the risk assessment and measurement. After identifying the risks properly, next step is to assessing the likelihood and potential impact on the company financial health. This can be done using like sensitivity analysis, stress testing, and scenario analysis. Then risk control and mitigation steps. This step involves taking action to minimize the risks or eliminate the identified risks. This could be done through hedging, diversification, or adjusting business strategy. Next, the risk monitoring and reporting. Continuous monitoring of risk exposure and regular reporting to stakeholders are essential for adjusting strategy and ensuring risk management process remains effective. Next is the risk review and judgment. Risk management is an ongoing process and company need to periodically review and adjust their strategy based on the changes in the market condition, business operation and financial objectives. Conclusion. Effective financial management. Financial risk management is essential for a company to safeguard against uncertainties and ensure long-term profitability. By identifying, assessing, and managing risk systematically, firms can reduce the likelihood of company significant financial setbacks and create a stable environment for growth and innovations. Thank you so much. Sir, very much.